Hi everyone, welcome to my YouTube channel which is Explore Yourselves, Banking and General Knowledge etc. Today I am going to discuss about overview of repo rate trends 2010 to 2025. Introduction. Today I will be presenting an overview of repo rate trends in India from 2010 to 2025. The repo rate is one of the most important monetary policy tools used by the Reserve Bank of India to regulate liquidity, control inflation, and support economic growth. Over the last 15 years, repo rate movements have reflected the Reserve Bank of India's response to changing economic conditions such as inflationary pressures, growth slowdowns, global financial crisis, and extraordinary events like the COVID-19 pandemic. Understanding these trends helps us appreciate how monetary policy decisions influence borrowing costs, investment behavior, and everyday financial decisions of households and businesses. Repo rate as on 19th March 2010, 5%. Repo rate as on 20th April 2010, 5.25%. Repo rate as on 2nd July 2010, 5.50%. Repo rate as on 27th July 2010, 5.75%. Repo rate as on 16th September 2010, 6%. Repo rate as on 2nd November 2010, 6.25%. Repo rate as on 25th January 2011, 6.50%. Repo rate as on 17th March 2011, 6.75%. Repo rate as on 3rd May 2013, 7.25%. Repo rate as on 20th September 2013, 7.50%. Repo rate as on 29th October 2013, 7.75%. Repo rate as on 28th January 2014, 8%. Repo rate as on 15th January 2015, 7.75%. Repo rate as on 4th March 2015, 7.50%. Repo rate as on 2nd June 2015, 7.25%. Repo rate as on 29th September 2015, 6.75%. Repo rate as on 5th April 2016, 6.50%. Repo rate as on 4th October 2016, 6.25%. Repo rate as on 2nd August 2017, 6%. Repo rate as on 6th June 2018, 6.25%. Repo rate as on 1st August 2018, 6.50%. Repo rate as on 7th February 2019, 6.25%. Repo rate as on 4th April 2019, 6%. Repo rate as on 6th June 2019, 5.75%. Repo rate as on 7th August 2019, 5.40%. Repo rate as on 6th February 2020, 5.15%. Repo rate as on 27th March 2020, 4.40%. Repo rate as on 22nd May 2020, 4%. Repo rate as on 6th August 2020, 4%. Repo rate as on 9th October 2010, 4%. Repo rate as on 4th May 2022, 4.40%. Repo rate as on 8th June 2022, 4.90%. Repo rate as on 5th August 2022, 5.40%. Repo rate as on 30th September 2022, 5.90%. Repo rate as on 7th December 2022, 6.25%. Repo rate as on 8th February 2023, 6.50%. Repo rate as on 8th June 2023, 6.50%. Repo rate as on 18th September 2024, 6.50%. Repo rate as on 6th December 2024, 6.50%. Repo rate as on 7th February 2025, 6.25%. Repo rate as on 9th April 2025, 6%. Repo rate as on 6th June 2025, 5.50%. Repo rate as on 6th August 2025, 5.50%. Repo rate as on 5th December 2025, 5.25%. Repo rate trends. A decade-wise breakdown. Understanding how repo rates have evolved over the past 15 years offers useful context for how monetary policy in India has responded to both domestic and international pressures. Below is a decade-wise summary that traces key movements, monetary responses, and economic backdrops that shaped each period. 2010 to 2014, battling inflation with cautious tightening. The early 2010s were characterized by a series of upward adjustments. From March 2010 to March 2011, the repo rate rose steadily from 5% to 6.75%, followed by additional hikes that peaked at 8% by January 2014. Key observations. The primary goal during this time was to curb inflation, especially food and fuel inflation. Repo rate hikes were implemented in small steps, typically 25 basis points. The economy was still absorbing the aftershocks of the global financial crisis, which made inflation management a top priority. By the end of 2014, the policy shifted slightly towards easing as inflation began to moderate, with the rate moving down from 8% to 7.75% in early 2015. 2015 to 2019, transition towards growth support. This period saw a clear shift in tone. Between January 2015 and October 2016, the repo rate declined from 7.75% to 6.25%. By mid-2018, the rate began inching back up, reaching 6.50% again in August 2018, before resuming its downward trend in 2019. Key observations. The rate cuts during this time were aimed at supporting consumption and investment. Monetary policy was more accommodative, reflecting a growing concern around slowing economic growth. After some mid-period hikes, 2019 saw consecutive rate cuts, bringing the repo rate down to 5.15% by early 2020. This phase marks one of the more balanced approaches, where inflation was under control for the most part, allowing rate reductions to stimulate demand. 2020 to 2021, crisis management during the pandemic. This period was unprecedented. The economic impact of the COVID-19 pandemic led to an emergency policy response. Between February 2020 and May 2020, the repo rate fell sharply from 5.15% to 4%, while it remained unchanged until 2022. The observations. The rate was cut by 75 basis points in one move on 27th March 2020, the steepest cut of the decade. The objective was to improve liquidity, reduce borrowing costs, and support the broader economy through uncertain times. Monetary easing was accompanied by various relief measures, including moratoriums and a special liquidity windows for financial institutions. For nearly 2 years, the repo rate was held steady at 4%, marking the longest period of status quo during this era. 2022 to 2023, sharp tightening amid inflation concerns. As economies began reopening globally, inflationary pressures returned, both from supply chain disruptions and rising commodity prices. India responded with a series of rapid repo rate hikes beginning in May 2022. In observation, the repo rate increased from 4.40% in May 2022 to 6.50% by February 2023. These hikes were paced aggressively, three consecutive increases of 50 basis points each and a fourth increase of 35 basis points in 2022. The hikes were aimed at anchoring inflation expectations without derailing the recovery. By mid-2023, the repo rate was stabilized at 6.50%, suggesting a wait and watch stance as inflation metrics began to show signs of moderation. 2024 and 2025, easing to balance growth and stability. After remaining unchanged at 6.50% throughout 2023, policy adjustments resumed in early 2025. The repo rate was reduced in two steps, first to 6.25% in February 2025 and then to 6% in April 2025. The observations. These modest reductions reflected a measured return to supporting growth without risking inflation resurgence. The decision to lower rates came after inflation had started easing and the economy showed signs of uneven growth. The move signaled flexibility in monetary policy, responding not just to inflation but also to broader macroeconomic indicators. The approach during this time was clearly cautious, showing that focus was shifting towards sustaining recovery rather than overcorrecting. June 2025 MPC meeting, another expected cut. As of early June 2025, market consensus strongly anticipates a third consecutive 25 bps repo rate cut at the upcoming MPC meeting, potentially lowering the rate to 5.75%. This expected move reflects the RBI's continued focus on supporting growth amid subdued inflation, which remains near 3.2%. The accommodative stance is likely to persist, balancing growth revival efforts with vigilance over inflation risk and financial stability. However, the RBI will also monitor global developments, including ongoing US tariff impacts and geopolitical tensions, which could influence the pace and magnitude of future rate adjustments. Repo rate changes impact daily life. Understanding repo rate trends helps not just analysts or economists, but also everyday individuals. Here's how. Home loan EMIs. As repo rate change, so do home loan interest rates. A cut in repo rate may result in lower monthly EMIs, provided the loan agreement is linked to an external benchmark. Personal loans and auto loans. Floating interest rates in personal or auto loans often reflect movement in the repo rate. A lower repo rate may make it more affordable to borrow for immediate needs or purchases. Business borrowings. Small and medium enterprises often adjust their working capital strategies based on prevailing repo rates, especially when planning expenses or covering operational costs. Savings and investment decisions. When there is a repo rate hike, financial institutions may offer better interest on deposits. Conversely, lower repo rates often mean reduced returns on fixed deposits FDs, prompting many to consider investing in fixed deposits while rates are high, or to diversify into equity or hybrid investments. What drives repo rate decisions? Repo rate changes are not arbitrary. Several influencing factors go into each decision made by the central bank. These include inflation forecasts. Managing consumer price levels is a key priority. Gross domestic product trends. Slower growth can prompt rate cuts to boost consumption. Employment data. Weak job growth may indicate the need for a monetary push. Currency movement. Volatility in the rupee may lead to defensive or preemptive action. Global cues. International interest rates, especially in major economies, play a role. Facts. What is the current repo rate in India? The current repo rate as of December 2025 is 5.25%. How do repo rate changes influence fixed deposit interest rates? FD rates usually move in tandem with repo rate changes, but with a lag. When the RBI cuts the repo rate, banks and NBFCs tend to reduce FD interest rates to align with their lower cost of funds, resulting in lower returns for new FD investors. What investment strategies should FD investors consider amid an easing repo rate cycle? Investors should consider locking in current higher FD rates, especially for longer tenures, before further rate cuts, employing laddering strategies, splitting investments across different maturities can balance liquidity needs and interest rate risk. How does the RBI balance inflation control with economic growth when adjusting the repo rate? The RBI uses inflation targeting as its primary mandate, aiming for 4% CPI inflation with a plus minus 2% band. It raises rates to contain inflation and lowers them to support growth, carefully monitoring global and domestic economic indicators to avoid overheating or recession. Why did the RBI maintain a steady repo rate for so long before starting the easing cycle in 2025? From 2022 to 2024, inflationary pressures from supply chain disruptions and commodity price high spikes compelled the RBI to keep rates elevated to anchor inflation expectations. Only after inflation moderated below target in early 2025 did the RBI begin easing to support growth. What risks should investors be aware of in a prolonged low repo rate environment? Prolonged low rates can lead to inflation resurgence, currency depreciation, and excessive risk taking in asset markets. Investors should diversify portfolios, monitor inflation trends, and maintain liquidity buffers to navigate potential volatility. Conclusion: the analysis of repo rate trends from 2010 to 2025 highlights the RBI's dynamic and calibrated approach to monetary policy. Periods of tightening were primarily aimed at controlling inflation, while phases of easing focused on stimulating growth and supporting the economy during slowdowns and crises. The sharp cuts during the pandemic underscored the RBI's role as a stabilizing force in times of uncertainty, while the subsequent tightening cycle reflected renewed inflation concerns. Recent easing signals a cautious shift toward growth support while maintaining price stability. Overall repo rate movements demonstrate the delicate balance the RBI maintains between inflation control, economic growth, and financial stability, directly impacting loans, savings, investments, and overall economic confidence. Disclaimer: this presentation is prepared solely for academic, informational, and educational purposes. The repo rate data analysis are based on publicly available information and general market understanding as of the stated periods. The content does not constitute financial investment or policy advice. Readers and viewers are advised to consult official RBI publications or qualified financial professionals before making any financial or investment decisions. The presenter assumes no responsibility for decisions taken based on the information shared herein. Thank you very much for your patience. Request for like, subscribe, and share.